Welcome. My name is David Schuette. I'm a partner in the capital markets practice at Mayer Brown. I'm going to summarize the revisions that the SEC recently made to Rule 10b5-1, as well as related disclosure and filing rules. As you know, Rule 10b5-1 establishes an affirmative defense against claims of unlawful insider trading. Under that rule, a trade is not considered to have been made on the basis of material, non-public information if it is made pursuant to a plan that was established prior to the time the person became aware of the information. That element of the rule remains unchanged. However, the SEC has now added additional conditions that must be met for the rule to apply. Those additional conditions depend on whether the person is the issuer, a director or executive officer of the issuer, or another person seeking to rely on the rule. The first and most significant additional condition is the imposition of a cooling off period. That is, the minimum period that must elapse between the time the plan is adopted and the first trade under the plan. For the issuer, there is no required cooling off period. For directors and executive officers, the minimum period extends from the time a plan is adopted until the later 90 days or the second business day after the filing of the Form 10Q or Form 10K for the period during which the plan was established, up to a maximum of 120 days. So, regardless of when the Form 10Q or Form 10K is filed, the minimum period never needs to exceed 120 days. For all other persons, the minimum cooling off period is 30 calendar days. Please note that any modification of the price, amount, or timing of trades under the plan is considered to be the termination of the plan and the adoption of a new plan, therefore requiring a new cooling off period to elapse before trades under the plan may resume. The second new condition is the requirement that directors and executive officers certify that at the time they adopt the plan, they are not aware of any material non-public information and are adopting the plan in good faith and not as part of a plan to evade the prohibitions of the rule. This certification requirement applies only to directors and executive officers. The third new condition is a prohibition on overlapping plans. This condition does not apply to the issuer, but to all other persons seeking to rely on the rule. There are three exceptions to this prohibition on overlapping plans. First, a person may have multiple trading plans with different brokers as long as they collectively comply with the rule and are treated as a single plan for purposes of any modification. Second, there is an exception for plans that operate sequentially. So one may enter into a second plan under which trades begin upon termination of the current plan. The third exception is for so-called sell-to-cover plans that provide for the sale of shares solely to cover tax withholding obligations upon the vesting of an equity award, such as an RSU. The next new requirement added to the rule is a limitation on single trade plans. This limitation does not apply to issuers, but to all other persons seeking to rely on the rule. Under this provision, unless the plan is an eligible sell-to-cover plan, the type I just described, then a person may not enter into a plan that is designed to affect all trades under the plan in a single transaction if that person has, during the prior 12 months, adopted a similarly designed single trade plan. Finally, in addition to entering into the plan in good faith, which is an existing requirement of the rule, the person must now act in good faith with respect to the plan. These revisions to Rule 10b5-1 apply to all plans adopted on or after February 27, 2023. As I noted, there were a number of other rule changes made in connection with the revision of Rule 10b5-1. Under the Section 16 reporting scheme that applies to directors, executive officers, and 10% holders, the Form 4s and Form 5s that these persons are required to file have been amended to add a new checkbox to indicate that the transaction was made pursuant to a plan intended to satisfy Rule 10b5-1. And if so, one must indicate the date the plan was adopted. This change is effective for reports filed on or after April 1, 2023. Another change to the Section 16 reporting scheme concerns gifts. Gifts are no longer eligible for delayed reporting, but instead must be reported on a Form 4 filed within 2 business days. The SEC has orally confirmed that this change is effective on February 27, 2023. Finally, there are a number of new disclosure obligations imposed on issuers. Starting with the full fiscal period beginning on or after April 1, 2023, that is, the second quarter for issuers with a calendar fiscal year, issuers must disclose whether their directors or executive officers have adopted or terminated a trading arrangement during the period covered by the report. This disclosure applies to both plans intended to comply with Rule 10b5-1, as well as other advanced trading arrangements. Issuers must disclose the name of the director or executive officer, the date of the plan, the duration of the plan, and the number of securities covered. Issuers will also be required to make annual disclosures of their insider trading policies and procedures. For calendar year issuers, this disclosure will be included in next year's proxy statement in Form 10-K. Lastly, to supplement their annual executive and compensation disclosures, issuers will be required to include a new table showing option grants made to any named executive officer during the last fiscal year if the grants were made during the period beginning 4 business days before the filing of a Form 10-K or Form 10-Q or Form 8-K that discloses material non-public information and ending on the business day after the filing. This table will disclose, among other information, the change in the market price of the issuer's stock from the trading day prior to this disclosure to the trading day after the disclosure. To learn more, please see our Free Writings and Perspectives blog.